Hey everyone, Paul here, and Zoom posted their earnings on November 30th, 2020. So we're looking at the first trading day since the announcement came out. And what happened? Well, their sales, they reported year over year, were up 367%. Their net income was up 9,800%. We take a look at those there. And so what happens when you have results like that? When your sales are up over 300%, when your net profit is up nearly 10,000%, okay? Like what happens? I mean, clearly, the stock has got to be doing well after that, because it's not even that it just beat year over year, it beat most analysts' expectations. But what's happened to the stock? Well, the stock, ladies and gentlemen, is down. Hopefully you can see those are a little thin, whatever. But, paper aside, the stock is down by double digits today. So the last check, they're down by about 14%. And again, it's not just that they're down. You'd be thinking about, okay, the market's up today. It's a green day for a lot of stocks. And we see Zoom have this blowout quarter, and yet they're down. Well, why is that? Well, let's go ahead and take a look at some of the quarter trends. We're going to look at the quarter trends for sales and gross profit. We're going to look at this for the first 3 quarters of this year versus the first 3 quarters of last year. So let's go ahead and take a look at that. Pull it up right now. So we see most recently that the sales here were actually up, and this is in thousands. So when we look at this, the 328,000 is 328 million. So they went from April 2020, 328 million to over 663 million. And then most recently to $770 million in terms of what their revenue was. So the revenue on a year-over-year basis, again, was up to 367%. Huge number, right? But I think, part of the thing that investors are starting to wake up to a little bit with this is that while that is a huge growth number on a year-over-year basis, the sequential growth, so if you look at what it was from the previous quarter to this quarter, well, that actually only represented on a quarter-over-quarter basis about a 17% increase in sales. Again, really, really strong number, but that's starting to give you some idea about what they're going to be up against next year when they're going to be trying to annualize the current numbers. They're going to be up against some really challenging numbers to beat when they start heading into 2021. And I think investors are starting to, again, start to realize that and process that a little bit more concretely than when they were just posting breakaway quarters, pretty continuously there. And again, part of the reason that is so interesting is I have a different model that I put together. We're going to get into that in a minute here, but I've got a different model that basically says, okay, well, what if they grow their sales at this pace, for the next couple years and maybe the out years? You start to look at some of those things. Well, they really need to have their sales between, years 3 and 10 through the forecasted model. They would need to have their year-over-year sales increasing consistently by 30% to get anywhere near a valuation that makes sense for them to be at prices where they're at today. And again, so when we start talking about sequential quarter growth of 17% when 2020 is already a really good year for them, I think that is part of the reason why investors are a little spooked, right? Because, and I know I wanted to film this because I know that there's a lot of investors out there who, think either that the market's rigged, or they think that, hey, how can this possibly be when the numbers are so good, but the stock falls? And that's exactly how it can happen. Because when you have a stock that is predicated on growth like Zoom is, they need to be growing so aggressively that if they're almost not, growing their revenue by, 20-30% on a sequential quarter basis, their valuation becomes under attack a little bit, okay? So it's just harder to justify. So what are some other highlights that we have here? So we see that the gross margin, in the quarters that we're looking at here, the gross margin was compressed a little bit for the most recent quarter. That fell to 67%. That was down about 4 percentage points from the previous quarter this year, but that looks worse when you're comparing it to last year. Now, keep in mind, last year they were earning gross margins at about 80%. That's really, really ridiculously strong. So the fact that they've kind of normalized that a little bit, that's not a huge sign of weakness, but it is something to, again, be aware of, that on a year-over-year basis, the gross margin is compressing, and now even on a sequential basis from the previous quarter, we see that shrinking as well. So we talk about that revenue compression, but with a part of that gross margin percent shrinking on a quarter-over-quarter basis, with sales growing from the previous quarter by over 17%, gross profit only increased by 10%, okay? So now with that model that I was telling you about earlier, let's go ahead and jump into that now. Okay, here we go. So with this model, this is taking a look at, the current shares that are outstanding. It's looking at some of the growth rates that we can play around with. And when I was first looking at this, I wanted to say, okay, what would it take in, 2030 or in about 10 years from now, what would it take to justify this stock being worth, what it's currently trading at? And what it would take, and I mean, to really basically say that you would not, as a shareholder, get any growth, but you wouldn't lose any money, for that scenario to happen, they would need to be valued at 9 times sales 10 years from now. And I know that they're currently trading at it's like 45 times forward sales, or they're trading at some absurd number, but that's not sustainable, in any sense over a 10-year period. But I do expect them to still be valued at a premium in 10 years from now. But even then, I think 9 times sales is pretty aggressive for what will be by 2030 a fairly mature tech company, if they're going to go on to continue to have success. So we put them at 9, and then even if we said that, okay, in the next year, that year over year, they're going to grow by 55%, and then they're going to grow by 40%, and then they're going to sustain that 30%. Well, then that, and also, by the way, assuming that they actually don't issue any more shares, that gets you back to a point where you could say, okay, they're worth about $450 in that scenario. But again, with that most recent update and looking at that sequential slowdown in growth, what if we plugged in and said that 17% was maybe going to be more, what they could expect on a year-over-year basis going forward, that they're going to be growing by 17%, like let's say in years 3 through 10 in a 10-year forecast, which again, let me remind you that is really still strong growth. With these numbers the way I'm putting them together right now, this would still imply that over the course of 2021 to 2031, looking at their fiscal year here, that would still mean that this company would be growing by 6 times in terms of their sales. But what happens with the share price if all of a sudden you're expecting that lower growth? Well, all of a sudden now in this scenario, you'd be looking at shares being worth about $175 per share. Again, based on them not issuing any more shares. I don't think that's entirely realistic, but at least the good thing about Zoom is they do have a strong balance sheet. I don't think this is going to be a matter of them needing to dilute shares to fund the business. If they're going to have any shares increased, it's more so going to be from stock options and incentivizing management and things along those lines, which are a more positive way to have a little bit of dilution. So I think that looking at that number and saying that, hey, in 10 years, even if they were able to grow by these amounts, that they would only be worth $175. I think this is, again, part of the reason that the stock is down today. And quite honestly, I think that there's going to continue to be some compression in the stock price of Zoom. And now, I have no idea when it's actually going to take place. I have no idea, how low it's going to go or when it's going to go. And I mean, the markets can remain irrational for a very long time. And, I know that as we head through the rest of 2020 and as we head into 2021, Zoom, I think, is going to continue to benefit from the storyline because, there's a good chance that we're going to have, some increased lockdowns heading into early part of next year. And I think anytime that you start talking about lockdowns, I think Zoom kind of becomes more of the buzzword. They get more publicity, and I think that there could be even more room for speculation with this stock. But again, I think in the long term, I think you're going to eventually be looking at this stock trading, below $300 a share. And, we're going to be looking back at 2020 as the high watermark for a very long time for Zoom stock. So thanks for watching. Just wanted to give you the quick update. Wanted to also kind of, again, try to help educate about why stocks can be down even when you have a quarter that looks so good like Zoom posted yesterday. Love to know what you guys think about this video, what you think about Zoom. Let me know in the comments below, and I will see you next video.